All right, let's tackle a huge question today. Where does the money actually come from to turn a brilliant idea into a world-changing company? We're going to break down equity financing, which is pretty much the engine that powers all of that growth.
I mean, really think about it for a second. Every major company you can name, from the tech giants to the big retail brands, they all started small, and they all needed cash, a lot of it, to hire people, to build their products, and to actually find customers. For most of them, the answer was selling a piece of the dream.
And that, at its core, is what equity financing is all about. The best way to think about it is like a pie. When you start your company, you own the whole pie. But to make that pie way, way bigger, you sell off little slices of it to investors in exchange for capital. Sure, you own a smaller percentage, but the pie itself becomes exponentially more valuable. This slide right here, it gets to the absolute heart of the dilemma that every single founder faces. On one hand, you get a ton of cash without the pressure of having to make loan payments every month. That gives you incredible flexibility to innovate and grow. But on the other hand, you dilute your ownership. You're giving up a piece of control and a share of the future profits. It is the ultimate trade-off. So, to make this real, let's follow the journey of a hypothetical company. We're going to start at the very beginning, when it's just an idea, maybe a prototype, and a couple of really passionate people. This is the classic path you hear about all the time. It starts with the founder's own savings, the pre-seed stage. Then comes the seed round, that first bit of outside cash to prove the concept actually works. If you can do that, you hit the big leagues. Series A to build a real business model, Series B to scale up and grab more of the market, and Series C for just massive, aggressive expansion. Each step up that ladder brings in more and more capital. Okay, so who is writing these early checks? Well, you basically got two key players. First, you have angel investors. These are wealthy people investing their own personal cash, and they often act as mentors. But then you have venture capitalists, or VCs. They're a whole different ballgame. They manage these huge pools of money from big institutions, they take a larger stake in the company, and you can bet they're going to want a board seat to help steer the ship. So let's fast forward. Our little startup is all grown up. It's now a mature, successful company, but it's still privately owned. And to get to that next level, it needs even bigger injections of cash. And this opens up some really exciting new funding options. For these mature companies, two really interesting paths emerge. You have private equity firms, which target these established, profitable businesses, and they'll often buy a majority stake to really optimize them. And then you have something totally different, equity crowdfunding. This is a much more democratic approach, where a company can sell shares directly to its biggest fans and customers through online platforms. And now, for the main event. The moment a company steps out from behind that private curtain and onto the world's biggest financial stage. Yep, we're talking about the IPO. An initial public offering is exactly what it sounds like. It is the very first time a company offers its shares for sale to the general public on a stock exchange. This is a massive, massive step. It transforms a private business into a publicly traded corporation that anyone can invest in. So why go through all the hassle? Well, the reasons are huge. An IPO can raise an enormous amount of capital, enough to fund huge acquisitions or totally rebalance the company's books. But, and this is critical, it also provides an exit. It's a way for all those early investors and employees to finally cash in on their shares. It's an absolute game changer for them. But here's the thing, going public isn't a one-size-fits-all kind of deal. Different markets exist for different size companies. In the UK, for example, you've got the AIM market, which is designed for smaller growing businesses. And then you have the main market, which is home to the giants, the FTSE 100 companies, where you can raise billions. You'd think the story ends with the IPO, right? Well, not even close. Once a company is public, it can actually go back to the market for more funding. And as we're about to see, there's a really critical detail in how that works that you need to understand. This is called a follow-on public offering, or FPO. It's pretty simple. If a company that's already public needs more cash, it can just create and sell more shares to the public. It's an incredibly powerful tool for established companies to keep fueling their growth. And the scale here can be just breathtaking. Get this. Just 1 year after its famous IPO, Google went back to the market with a follow-on offering and raised over $4 billion. That just shows you the incredible financial firepower that's available once you're a public company. Okay, this is so important. This is the crucial point. When a company sells stock, you have to ask one simple question. Who gets the money? In a primary offering, the company creates brand new shares and the cash goes right into the company's bank account to fund growth. But in a secondary offering, it's the existing shareholders, like the founders or VCs, selling their own shares. The money goes into their pockets, not the company's.
So why would a company do one of those primary follow-on offerings? Well, it's all about strategy. They might need a boatload of cash to fund a major expansion or maybe acquire a competitor. Or sometimes it's just to pay down debt and make their financial position rock solid, especially if things in the economy look a little shaky.
I love this quote because it just nails the whole concept. Selling ownership feels really expensive, right? You're giving up a piece of your creation. But when a business desperately needs capital just to survive or to jump on a once-in-a-lifetime opportunity, the cost of not raising that money can be infinitely higher.
And that brings us right back to our pie. This is the question that every founder, every investor, and every business leader has to answer for themselves. Equity financing is the tool that lets you make that trade, to exchange a little bit of ownership for the chance to create something absolutely massive.